This is an Uncovered Japan Company research report on Takada Corporation, ticker 1966. Takada is a Japanese plant engineering and maintenance contractor rooted in Kita, Kyushu, whose customers include steel, chemical, and semiconductor plants. We will look at the maintenance moat, the financial evidence, the valuation, and the risks that determine whether its record backlog can become better earnings. The starting snapshot has two sides. Maintenance work is 96.2% sole sourced. The carried forward backlog reached a record 29.1 billion yen, and the shares traded at 0.58 times book value, with a 4.06% dividend yield. But operating margin fell to 3.3% in fiscal 2026. And the investment case rests on whether the growing order book can convert into profitable, cash-generative work. Takada sits between mega engineering contractors and local trade shops. It handles plant construction, equipment installation, fabrication, and scheduled periodic shutdown maintenance. The business model is important. A plant it helps build can become a plant it is positioned to maintain for decades. That maintenance work depends on safety, responsiveness, and plant-specific know-how, which is why repeat business is more valuable than a one-off construction contract. The customer mix shows both diversification and concentration. In fiscal 2026, steel and ironworks accounted for about 40% of parent completed works, chemicals about 37%, and electronics and semiconductors about 11%. Semiconductor work offers a visible growth vector, but steel and chemicals still account for roughly 77% of the total, so the company remains tied to a few large industrial customers. Fiscal 2026 was a poor earnings year. Revenue fell 7.5% to 53.7 billion yen, while operating profit fell 39% to 1.8 billion yen. Cost inflation, lower fixed cost absorption, and higher interest expense all mattered. Yet new orders rose 22.7%. The result is not simply lost demand. It is a mismatch between current revenue and a larger pipeline of future work. The backlog is what reframes the down year. The parent's carried forward order book rose 72%, from 16.9 billion yen to a record 29.1 billion yen, equal to roughly 62% of annual revenue. Much of the work is tied to multi-year plant renewal activity. The caveat is crucial. Backlog measures volume, not margin. Its quality will be proved only as projects are completed and billed. The profit slide was sharper than the revenue slide, because margins are thin. Operating margin fell from 5.1% in fiscal 2025 to 3.3% in fiscal 2026. Higher materials and labor costs matter greatly in a contractor with slim gross margins, while the construction contract loss provision rose from 30 million yen to 99 million yen. The key question is whether this is cyclical pressure or a structural limitation of the business. The defining quality statistic is that 96.2% of maintenance work is sole-sourced rather than competitively tendered. Customers rely on Takada's safety record, local presence, and accumulated knowledge of particular assets. That makes the franchise defensible. It also has a flip side. Nippon Steel alone represented 30.3% of parent completed works, so the trusted customer model is also a meaningful customer concentration risk. Valuation is the attraction. At a share price of 1,774 yen, Takada traded at 0.58 times book value, against book value per share of 2,965 yen. The annual dividend was 70 yen, or a 4.06% yield. The balance sheet is sound rather than distressed. Fiscal 2026 equity ratio was 45.5%, and net debt was about 32% of equity. The report's 3-year scenario analysis is illustrative, not a price target. It frames a bear case of 966 yen, a base case of 2,410 yen, and a bull case of 4,411 yen. The spread is driven by margins, backlog conversion, and the valuation multiple. The base case assumes earnings recover more strongly than the company's cautious guidance, which is why investors should treat the margin and cash flow evidence as the key proof points. 4 things are worth monitoring. First, whether the record backlog converts at an acceptable margin. Second, whether operating cash flow turns sustainably positive as contract assets are billed and collected. Third, demand from major customers, especially Nippon Steel. And fourth, whether the next midterm plan gives investors numerical targets for growth and profitability. These are more important than a static valuation multiple. To sum up, Takada is a plant contractor with a real maintenance moat, a record order book, and a sound balance sheet, trading well below book value. The counterweight is equally real: thin margins, negative operating cash flow during the backlog build, and customer concentration. The thesis depends on profitable conversion, not simply more orders. This is research for educational purposes only, not investment advice. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.